please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Have to ponder about the big macro news that's going to hit us, the budget. We just got a bit of a macro news yesterday when the government reduced its extra borrowing program from 50,000 crore to 20,000 crore, saying that it has reassessed its revenues and expenditure. Rating agency Moody's has been, of course, one that's already been positive on India and China as well. They expect both these economies to be the fastest growing economies in the Asia-Pacific region. Marie Duron, Senior Vice President, Sovereign Risk Group at Moody's Investors Service, has joined us now. Good morning, Marie. Thank you very much for joining us. Well, first up, how did you read the Indian government's announcement that it will borrow less extra? It is still borrowing extra, but less than previous. Are you getting more confidence that this year's deficit will not fly too much, will not be too much above the budget estimate?
Yes, so in that very announcement, there might not be so much really from a sovereign risk perspective to read into. One is governments do adjust their borrowing plans. They also adjust the kind of the structure of the financing between different instruments. We see that in a number of places. Second is that the amounts or the adjustments for 50,000 crores to now 20,000 is relatively small in relation to the size of overall borrowing and the size of the Indian economy. So it would not really materially affect the kind of fiscal metrics going forward. And last, and that's really a kind of a particular feature of India, and one that is relevant to the sovereign rating, is that it is relatively insulated from fluctuations in yields by the long maturity of its debt. So adjustments of kind of borrowing from one year to another do not have really a significant impact on the overall cost of debt. So overall, we do not think that there is too much really that is directly relevant to the sovereign rating there. As far as the fiscal picture is concerned, we expect that the budget deficit that will be announced will be somewhat higher than budgeted at this time last year. So we expect for the general government as a whole a deficit of around 6.5% of GDP. That would come with a stabilization in debt, but the upgrade in the rating that you kind of hinted at earlier, so we rate India at Baa2 with a stable outlook. That really takes that medium-term perspective on the fiscal and on the growth side, and that with, over time, strong growth in India continuing and indeed picking up from last year, then we expect the fiscal metrics to gradually improve and strengthen and the debt burden to ease somewhat.
Okay, this 6.5%, which is, I guess, state plus central deficit, how do you see that panning out next year? Because the GST has quite clearly benefited the states. So next year, the 6.5 becomes what, or what would you like it?
So we see a gradual kind of narrowing of the deficit. So the government really maintaining that stance of gradual fiscal consolidation. And so from at the center level, there might be scope for somewhat narrower deficit, in particular with the economy recovering. GST in itself is really designed to be revenue neutral in the first few years, and so we think that the revenue accretion will, for the general government, will come over time from increased tax compliance and from really potentially also increased productivity from a simplified tax system. But that we do not expect to really see immediate impact as of the next fiscal year.
So, Marie, if the government decides to run a higher deficit in order to push growth, what kind of growth targets are we looking at? What are you penciling in, both for India over the next 1 year as well as for China?
Yeah, so we expect, and we have seen signs that the Indian economy is recovering after the temporary shocks of demonetization and implementation of GST that led to some short-term disruptions. So for 2018 as a calendar year, we forecast a 7.5% growth rate in India, and we expect that to be maintained and growth between 7.5% or even potentially slightly higher over the next few years. Given the favorable demographics, given the momentum behind incomes catching up and productivity growth that we expect to see. For China, The trends are somewhat different there. We expect a gradual slowdown in China. Last year, 2017, surprised maybe on the upside, and so GDP growth is likely to be not much below 7%. For 2018, we expect a gradual slowdown towards 6.6%. The drivers of growth are quite different, and so in the case of China, for instance, the demographic drivers that I explained for India are much less favorable, and China is in the process of really rebalancing its economy more towards the services sector, and that could come with somewhat lower growth over time.
Okay, Mary, thanks a lot for your time today.